Um, Good afternoon. My name is Regina Hopkins, and I'm with the DC Bar Pro Bono Center, and I'd like to welcome you to our webinar this afternoon about how to handle charitable contributions. You will find a copy of the PowerPoint in the there's a thing called handouts on the right side of your screen in that sort of interface with GoToWebinar, and you can open that and download that. In addition, you'll see a chat box where you can type questions and ask me those questions, and I'm happy to answer them through the course of the webinar. It is being recorded so that you can go back and listen to it at a later date if you want to. So welcome, and we'll get started right now. Just a little bit of background about me. I've been with the DC Bar Pro Bono Center almost 11 years. Prior to that, I was the General Counsel for Habitat for Humanity, so I've been dealing with exempt organizations for about 26 years now, and I was a tax lawyer before that. So this is home turf for me. So with that, we'll get started. So today's session, we're going to talk about what is a deductible contribution. It's mostly straightforward, but there are a few wrinkles there. We'll talk a little bit about quid pro quo contributions, what they are, and the special rules that deal with them. We'll talk about the receipt requirements for cash contributions, what they are for donations in general, the special rules for larger donations, how to deal with payroll deductions, which in DC, because of the combined federal campaign, is something we have to think about. What happens with unreimbursed expenses? Someone who is a volunteer or a board member expends money out of their pocket on behalf of the organization. What are the rules for that? And then we'll talk about non-cash contributions, things like household goods, stock, other real and personal property if someone were to, if you were fortunate enough to get a donation of land, or personal property such as computers or office furniture, things like that. And then there are special rules for donation of vehicles. So let's begin by talking about what is a deductible charitable contribution. So what it is it's a voluntary. That's the first requirement, that it's something that people give you out of choice. And it's made without getting or expecting substantial benefits in return. So it's just something that you want to do because you feel someone supports your mission or admires your work, they make that contribution to you. But in order to be a deductible charitable contribution, it has to be made to a tax-qualified 501c3 organization. Anybody can go on the IRS website. They have what's known as Publication 78. And you can look up the name of an organization to see whether it, in fact, is exempt under the Internal Revenue Code. It is a good thing to do if you're a nonprofit organization to go and look up your status every once in a while. When I was at Habitat for Humanity, we had from time to time chapters that were deleted inadvertently. So we would have to add them back in. So it's good to just double check maybe once or twice a year to make sure you're still listed. The other thing that you want to check is to make sure you're still a public charity. There are special rules with respect to what is known as the private foundations, and they are more strict and they're subject to more regulation. So everybody, to the extent they can, wants to be a public charity. A lot of nonprofits are. Typical nonprofit will be. Basically, in order to be a public charity, it means that you get support. At least a third of your income is from the public or through government grants or grants from other nonprofit public charities. So most nonprofits qualify, but you can occasionally lose your public charity status, and so you just want to double check that as well. So what's a deductible contribution versus a non-deductible contribution? Well, it's deductible if it's made to a religious, charitable, educational, scientific organization or an organization that prevents cruelty to children or animals. Things that are not deductible are contributions to civic leagues or business leagues, social or sports clubs, labor unions, social welfare organizations. You'll see that a lot, like groups like the Sierra Club, which is an advocacy organization. Contributions to them are not deductible. And then political groups or candidates. It used to be that political contributions were deductible, but about 40 years ago now, the IRS, the Congress took that out of the Internal Revenue Code. The big thing to note is that a contribution is not deductible if contributions to foreign organizations are not deductible. There are certain exceptions for gifts to Mexican, Canadian, and Israeli charities. But generally speaking, they aren't. So if you took a mission trip to Haiti and you found this great orphanage in Haiti and you wanted to make a charitable contribution to them, that's admirable, but it's not deductible. So you would have to find a U.S. organization that would take it and then give it to the Haitian organization, but you couldn't give it directly to them. You will see, for example, in the U.S., a lot of Friends of Oxford University, Friends of Cambridge University, and those Friends of organizations are designed specifically to create a U.S. entity which can accept charitable contributions and have a deduction. So deductible contributions are cash or cash equivalents, such as gift cards. Cash is the best. Marketable securities such as stock, that's if you're in a position to donate stock, that's deductible. Unreimbursed out-of-pocket expenses, what we talked about before, the money that you expend on behalf of the charity. Privately held securities, these are businesses that are held by a limited number of individuals. They're not traded on the stock exchange. Those are deductible. From the donor's point of view, the big question is how the value of the privately held securities. From a nonprofit's point of view, the question is, what do you do with it? You can't sell them because they're a limited market. They're not owned by the general public, so it may not be worthwhile for you to take privately held securities. But that's one of them. Real or tangible personal property. The real property obviously is land. Tangible personal property would be household goods, office equipment, computers, things like that. And then there are intangible personal properties such as patents and copyrights. When I was at Habitat, we would get letters from people saying that if we funded the cost of them getting a patent on their invention, they would donate part of the proceeds to us and stuff. We declined the opportunities to do it, but that's one thing that people can donate, and if it's Microsoft Word, it's a good thing, but it's usually not. It's usually people who have been tooling around in their garage. So what is not deductible? Well, the first thing is the value of time or services, including professional services. So if you have someone who donates their legal services to your organization, thank them very much, because they're doing it out of the generosity of their heart. They're not getting a tax deduction. It's the same if someone donates plumbing services or accounting services or PR services. Any services are not deductible. There's no ambiguity about this. There's no question about it. The IRS this is black letter law, as we like to say, meaning it's not open to dispute. That's the rule. In the same vein, if someone donates to you a building, that's great, that's deductible. If they donate half of the ownership of a building, so you and the donor are 50-50% owners, again, great, deductible. But donation of what we call partial interest or less than whole interest in the property, such as donated office space or use of a facility for a gala dinner or something like that, again, they're not deductible. And again, just like donated services, this has been settled for a long period of time, and there really is no wiggle room here. And the reason why the IRS and the Internal Revenue Code has these rules is they're basically saying to them, whether or not someone would have hired you, or whether you would have rented this office space or rented this facility, and how much they would have paid is too speculative to generate a deduction. If I give you $50, it's clear I've given you $50. Or if I give you a share of stock that's worth $50, it doesn't, and I can go and the charity can go and sell it on the exchange and get their $50. There's no question about that, about the value and whether something of value has transferred and what that value is. But if I donate my time, the reason for the deduction you're saying is, or office spaces, I could have rented it to somebody else, or I could have worked for somebody else. Well, you could have, but maybe you wouldn't have. And maybe they would have paid you a certain rate, or maybe they would have paid you less. And so the IRS just feels, and the Congress just feels, that there's not enough certainty. Unlike cash or property, there's just not enough certainty to justify giving people a deduction. So that is why that is the rule. Okay. Lobbying expenses, or money given for lobbying expenses, is not deductible because it doesn't, as we know from the rules on lobbying, it's not considered part of your exempt permission, and therefore it's not deductible. The price of raffle, bingo, or lottery tickets are not deductible because the IRS believes that you're getting fair value for what you're paying. You're getting the chance to win something great and wonderful, like a car or something, a cruise or something like that. And so what you're paying for the raffle ticket is fair value for that chance to win. Bids at silent auctions are not deductible unless it's the amount you pay exceeds the value of the item purchased. So if there's a $50 gift card and someone, because they want to support the organization, bids $65 for the $50 gift card, then that $15 is deductible, but that's all. Tuition paid to a school or other amounts designated for a specific individual or small group of individuals are not deductible. You would occasionally see this at banks. People would have a little jar at the bank counter for someone. Now you can go to crowdfunding and see people raising money for a specific individual. Again, that's very commendable of them, but it doesn't generate a tax deduction because it's essentially a gift to that individual rather than supporting a charity's mission. And as we mentioned before, if you're a non-501c3 organization, such as a social welfare organization or political action committee, it's not deductible. So how much can a donor deduct? There are limits, and the first big limit is that in order to claim a deduction, someone has to itemize on their taxes. They can't take the standard deduction. They have to complete the Schedule A on the tax return in order to claim a deduction. So the charitable deduction definitely favors more wealthy individuals, more working class or others who give money to charity, generally don't get the benefit of their charitable deduction, don't get the benefit of the deduction because they're not itemizing. Deductions for contributions to a public charity cannot exceed 50% of a donor's adjusted gross income. So if I have $80,000 in adjusted gross income, the most I can deduct is $40,000. If I'm giving to private foundations, it's even less. It's $24,000. I have to do the math there. But you can carry it forward for 5 years, so that if I don't, let's suppose I make a major contribution in 1 year, but I can't deduct all of it, I have 5 years to go forward so I can deduct it. Okay. And then there is a special rule to deal with quid pro quo payments. These are our payments where I give you money and I get something in return. And under those rules, I can only deduct the amount by which what I gave you exceeds the fair market value of what you give me in return. So the donor must reduce the deductible amount by the value of the benefit received, even if the benefit was donated to the organization. For example, I pay $65 for a ticket to a church dinner, and the fair market value of the dinner is $25. The amount I can deduct is limited to $40, even if the cost of the dinner was donated to the church. And the reason is the Internal Revenue Code is looking at it from my perspective. What did I get? Did I really want to donate something, or was I buying something? And so it was, what was it worth to me rather than what it cost the church in this example. So if the dinner is worth $25, then my $65 ticket is partly in payment of that dinner and partly a deduction. So my actual charitable deduction is $40. And if the amount the donor pays, for example, in a silent auction, is less than the fair market value of the goods or services they receive in return, then the donor is not entitled to a deduction. And there's a question about silent auctions, which hopefully this will answer. If an organization receives a quid pro quo payment from a donor, partly a contribution and partly to pay for goods and services, such as a ticket to a fundraising dinner, and the payment exceeds $75, the organization must provide a written disclosure to the donor. Less than $75, it's up to the donor to figure out what are they getting versus what are they paying. That the Internal Revenue Code figures and the IRS figure, if it's $40 and the dinner's worth $20, we're not going to worry about the small stuff. But when it gets to exceed $75, then we want some more documentation to show that you're actually entitled to the amount you're claiming as a deduction. And the organization must give the donor a written disclosure that informs the donor that the amount of payment that is deductible is limited to the excess of the money received over the value of the goods or services received. So that they first have to tell them that your deduction is limited to how much you paid in excess of what you got in return, and they have to give a good faith estimate of the fair market value of the goods or services. So I have to come up with a value of the dinner I'm given, or the concert, or on a case of a silent auction, what I am bidding. Sometimes that's easy. For example, if the silent auction item is tickets to a Caps game, then you can look at the face amount of the tickets. If it's a concert, well, you can see what similar what people paid to go to concerts by that particular artist or similar artists. With meals, how much, you look at what's a typical dinner for the meal. Sometimes they're a little bit more nebulous, but generally speaking, that's the responsibility of the nonprofit to come up with an estimate of what the value is. And it only has to be a good faith estimate. What I would do is I would, when you're planning the event, I would, document how you come up with an estimate and put something in the file to show this is kind of how you figured it out. Some of them are pretty straightforward, but others you may have to sort of, particularly with the dinner, explain. You might go online and get a couple of menus and from similar restaurants, like if you're having a fried chicken dinner, what is fried chicken dinner's cost, and print the menus and stick it in the folder. Maybe a good way of coming up with an estimate. The disclosure may be made at the time of solicitation. For example, when you're first publicizing it, or on the ticket itself, or someplace, you list what the deductible portion is, or you can send an acknowledgement after the event and then disclose what the value of the goods or services received in return. If the payment is $75 or less, the organization doesn't have to provide the disclosure, but the donor is still subject to the rule. The donor still has to deduct the value of what they get. It's just the onus is on them for figuring it out versus the nonprofit. There is a penalty if you fail to disclose the value of any goods or service received for payment of more than $75. And the penalty is $10 per contribution with a maximum of $5,000 per fundraising event. So if you have a dinner and 75 people show up, and you don't give the appropriate disclosure, then you could be looking at a $750 penalty. If you have something even nicer or bigger, like a couple hundred people, you could be looking at more. But there is a cap of $5,000. So that's the good news. If there's a reason why you couldn't do it, you have reasonable cause, you may be excused, but you assume you're going to pay the penalty if you don't do it. Now, there are exceptions to these rules. Basically, you don't have to deduct the value of token goods and services, certain membership benefits, and intangible religious benefits. So, token goods and services are benefits given to a donor as part of a fundraising campaign, such as with public television. And in order to be considered token, either it has to, the fair market value of the benefits does not exceed the lesser of 2% of the donation or $106, or if the donation is $53 or more, the items must bear the organization's name or logo, and the items have to be low cost, meaning which they cost no more than $10.60 per year. Now, I know what you're thinking. $53, $106, $10.60, those are kind of odd numbers, and that's because they are adjusted every year to reflect increases in the cost of living. These are the 2016 numbers. They'll come out in 2017 with a new set of numbers. It's probably not going to adjust very much. Like from 2015 to 2016, it went from $105 to $106. It went from 52 to 53, et cetera. So, so that's what. So if you give people small items and you can fit into one of these limits, then you don't have to deduct the value of those. In addition, free unordered low-cost articles are also considered to be insubstantial. I don't know about you, but I get a lot of calendars this time of year from environmental organizations, and and they just come to. I've been getting them since September, basically, and so you don't have to deduct the value of those calendars because you didn't order them, you didn't request them. Similarly, the return labels or Christmas cards you get in the mail, same thing. So let's explain this. Let's look at this in example. Donor A buys a $200 ticket to a fundraising dinner for Charity X. The cost of the dinner to Charity X is $20 per person, but the dinner has a fair market value of $50. At the dinner, the guests receive a goodie bag, which includes a mug, t-shirt, and folding umbrella. The mug and t-shirt have Charity X's logo on them and cost $4 and $5 respectively. The umbrella is plain black, costs $6.50, and has a fair market value of $20. So how much can donor A deduct? Well, the answer is $130, and let's explain how we get there. The first thing you have to do is you have to deduct the fair market value of the dinner, which is $50 because it's the value, not the cost. It was $50, so that gets you down to $150. And then you have to deduct the fair market value of the umbrella, which was $20. And the reason is, although it could have been a low-cost article, it didn't have Charity X's logo on it. It was just a plain black umbrella, so it has to be deducted as well. So 150 minus 20 is how you get to the 130. The t-shirt and mug bear the logo of the charity, and together they cost less than $10.60. So you don't have to count those. Those don't reduce the value of the donation. So that's the rule for those types of, that's an example of this rule in play. Intangible religious benefits also don't reduce the amount of the deduction. The intangible religious benefits include any item that's given for exclusively religious purposes that's not sold in a commercial transaction. It might include wine in a religious ceremony. It might have the right to attend to specific religious services. Those are intangible and don't reduce the deduction. Benefits that are not intangible include a course where you get credit towards a recognized degree, travel services, and other consumer goods. And then membership benefits. Membership benefits can be quite lush or generous if your donation is big enough, but what the IRS here is talking about are basic benefits for the general public. So as long as your dues are $75 or less, you can receive free or discounted admissions, discounts on purchases, free or discounted parking, or free or discounted admission to member-only events, provided that they're pretty basic. It can't be a fabulous dinner. It can't be a luxurious cocktail party. It would be something where they had some, cheese cubes and vegetable crudité and a cash bar or something like that. But you get to see, like, say, an exhibit at a museum the day before it's open to the general public. Those types of things aren't substantial enough such that, they're available to people at a wide enough scale that they don't reduce the amount of the donation. Okay, let me see. Someone asked, how much is the range, or how much or range is a low-cost item? A low-cost item could be anything you want, as long as it bears the logo, and as long as when you add up all the low-cost items, they don't exceed $10.60. So you could give a T-shirt and a mug. You could give the umbrella with the logo on it. You could give, and then with a big enough donation, if someone gives you $50,000, then 2% of that is going to be $1,000, and you could give some, well, it would be 2% of that is $1,000, but $106, you could give someone $106 worth of stuff, and it would still be a low-cost item compared to the much larger donation. But generally speaking, it's we're talking about logos. Sometimes people have lapel pins, or they might have some other, like a cap. All of those, it can be anything, as long as it bears the logo, and when you add up the value of the low-cost items, they don't exceed $10.60. Okay, so acknowledging donations. As a general rule, nonprofits don't have to acknowledge donations at all. With the exception of the quid pro quo, you do not have to acknowledge a donation at all. It's the donor's responsibility to determine the value of their donation and substantiate it with the IRS. You might get in trouble with your donors, but not with the IRS if you don't acknowledge a donation. The donor, in order to claim a deduction, has to have some proof of the donation. Generally, a bank record, a credit card receipt, or a written acknowledgement from you all that they made the donation. Any of those would be sufficient in order to get the deduction. But there's an exception. If a donor makes a single donation of $250 or more, the donor must have a contemporaneous written acknowledgement of the donation from the organization. So any donation of $250 or more, the donor cannot claim a deduction unless you send them a written acknowledgement. So that's why, because they're important donors, they give you a good chunk of money, you want to make sure that you have acknowledged their donation so they can get the benefit of the deduction. So what does that mean? Contemporaneous means that the donor has the written acknowledgement in hand as of the date he or she files the tax return for the year in which the donation is made, or their due date, whichever is earlier. So I'm filing my tax return in March. I'm about to sign it and send it off to the IRS. I have to have that acknowledgement in hand. Now, you as a nonprofit can do one of two things. You can provide the the acknowledgement for the donation when it's made. For example, I make a donation of $250 in July. You send me an acknowledgement then. Or you can wait till the end of the year and give a statement, not unlike a W-2, of all the donors' donations during the year. I tend to make donations, for example, me, on credit card every month. It just gets charged to my credit card rather than making one larger donation. And at the end of the year, I get a statement from the couple of organizations I do this to, where they list all of the donations I made during the course of the year. And that's becoming more and more frequent. So if you haven't seen one, I was going to show you one, but I messed up. But I apologize. But that's what you can do. You can, in fact, have that written acknowledgement provided once a year, listing all the donations by that individual during the year, and you should provide it by January 31st. So that's something you can do as an alternative way of complying with this. And the acknowledgement that you have must contain all of the following language: the name of the organization, the amount of cash contributed, or a description, but not the value of any non-cash contribution, and one of the following statements, whichever is applicable. Either that no goods or services were provided by the organization in return for the services, it was not a quid pro quo contribution, or it was a quid pro quo contribution, and here's an estimate of the value of the goods or services that were provided in return for the contribution, or that any goods or services were intangible religious benefits. So you can do one of those three statements. And if you don't acknowledge this donation in a contemporaneously with all these required elements, the donor will not be able to claim a deduction, period. There is a very famous case that the IRS came out with, and the tax court came out with. There was this couple. They donated $30-some-odd thousand to their church. They must have, I'm guessing they were tithers. And the church sent them a letter that said, thank you on behalf of the XYZ church, thank you for contributing to us $35,000. We appreciate your support, very truly yours. And so you say, okay, and they went and they claimed it on their tax deduction, and when they were audited for totally different unrelated reasons, the IRS questioned the donation, they gave them that receipt. And the IRS said, that's great, but you don't have one of these three statements. You don't have a statement that no goods or services were provided, or you don't have a statement that they were, and here's the value, or that the services were only, the benefits were only intangible religious benefits. You don't have one of those, and so therefore we're not going to give you a deduction. And so they went back to the church and said, oh, give us a new receipt. So they gave them a new receipt on the behalf of the XYZ church. Thank you for donating $35,000. No goods or services were provided in return for the contribution. All set, right? No, it was not contemporaneous, meaning they didn't have it in hand at the time they originally filed their return. And they appealed it to the tax court, and the tax court said, nope, the IRS is right. This is what the statute requires. You didn't have the receipt in time that contained all the required language, no deduction. So even though they, in fact, donated $35,000, even though, in fact, the church was a 501c3, and, in fact, no goods and services were provided in return for the contribution, they could not deduct it, and they had to pay an additional $8,000 in income tax. I bet you they might have been unhappy with the church, so that's why it's important for larger donations that you make sure you give proper receipts. And I have a question. Someone asked, is it more appropriate to send it with each donation or send it at the end of the year? I think it really depends on you. I think for me, because I do it every month, it's probably better, because I do it on my credit card, getting the year-end one is actually more convenient for me and the like. But if you're getting a significant donation, you may want to at least do some acknowledgement, even if you give a more formal receipt at the end of the year. I think it's more of a donor management question rather than a legal question. Now, if someone gets through payroll deductions, like say the CFC, they have to, and their records include their pay stub or W-2 or some other document furnished by the employer or a pledge card. Those are sufficient documentation, although contributions of $250 or more are going to require the contemporaneous written acknowledgement, just like any other cash contribution. And the same with unreimbursed expenses. If I give a Toys for Tot, I give a toy to Toys for Tot, I can deduct the value of that toy, what I paid for it. I buy office expense, we're doing some sort of event, and I go to Staples and buy a bunch of stuff, keep the receipt, I can deduct the value of those goods. I'm hosting a wine and cheese party, a fundraiser at my house, and I go and I buy the wine and the cheese. Again, those are deductible as long as they are unreimbursed by the nonprofit. So those are all out-of-pocket expenses are deductible. They're unreimbursed, particularly if they're unreimbursed. They have to be unreimbursed, directly connected to the volunteer activity. They're only incurred because the donor was giving the services, and they're not personal living or family expenses. For example, you can deduct the cost of a uniform, but only if it's not suited for everyday use. So if you have some sort of program and everybody's supposed to wear a khaki shirt and a blue polo, khaki pants and a blue polo, because you could wear them anywhere, it wouldn't be deductible, but a candy striper outfit may be. The donor has to maintain records, and if their out-of-pocket expenses are $250 or more, think of the wine and cheese party, again, the donor would go to the organization and ask for a contemporaneous written acknowledgement that describes the services provided in connection with the out-of-pocket expenses and all the other information. Non-cash contributions, it's the same requirement in terms of substantiation. For donations of $250 or less, you have to have some sort of way of proving it. Now, in the case of donation of things like clothing or computers or something like that, you're not going to have a bank receipt. You're not going to have a credit card receipt. So you're going to need some acknowledgement from the charity, which includes the name of the charity, the date and location of the charitable contribution, and a reasonably detailed description of the property. The only exception to this rule is if you drop something off at a Goodwill box or one of those clothing boxes where people can just drop stuff off, then you don't have to have a receipt. But otherwise, you need a receipt for donations, smaller donations of property. But if you have something between $250 and $500, you have to get that contemporaneous written acknowledgement. Now, acknowledgements of donations of property, let me stress something right here. It is not your responsibility, nor should you, as a prudent matter, put a value on any donated property given to you. It's the donor's responsibility to establish the value of their gift. You cannot legally, if you say this is worth this computer system is worth $500, that's great, but the IRS doesn't care what you think it's worth. It's because you're not an expert and you don't value it, and they are not going to. If the donation is large enough, they'll just ignore your estimate, and it just gets you in the situation if someone's and it has been known to happen, inflates the value of that donation, either unwittingly or unwittingly. It's not your position as a tax-exempt organization to sort of back them up. So if someone says, oh, put down it's worth $500, say, I can't. Just say, our lawyers won't let us. Blame the lawyers or the accountants. Just blame your accountants. But basically, if someone gives you 5 laptops from their business, say thank you for the 5 laptops. Thank you for the 5 Dell laptops, series number XYZ. We appreciate your generosity, and then no goods or services are donated, whatever. Don't ever put a value on it. It's not your responsibility. The IRS isn't going to listen to you, but they could get mad at you if they think you're helping to contribute to some shady tax deductions. Again, if there's $250 or more, they have, in order for if the property is worth $250 or more, they must have a written acknowledgement. And in figuring the value of the donation, the donor may combine claimed items for similar donations, such as books or clothing or something. You don't have to put a value on every book. You can just say donated books or donated clothing. Now, once a donor claims a charitable deduction of over $500, but not over $5,000, they have to file a special attachment with their tax return called Form 8283. And let me just do this just for a second so I can pull it up. I'm going to show it to you. This is what it looks like. This is the Form 8283, non-cash contributions. The donor has to file this with their tax return. And if it's $5,000 or less or publicly traded securities, you have to put the information about the property, like when did you acquire it, how long did you hold it, what's your basis, et cetera, and various information. And on the second part, they have to, if it's large enough, if it's 5,000 or more, they have to have an appraiser fill out this section, the sections, like the declaration of the appraiser, that it's worth what it is. See, they have to get a professional appraiser. There is one thing that the nonprofit is asked to do, and that is to acknowledge that they received it. So if they give you some stock, or they give you donated office furniture or something like that, you run a food pantry and they're giving you donated food, they will have to file this form out, and they will come to you and they say, can you complete Part 4 of this, the donor acknowledgement, the donee acknowledgement. And what you're saying is, we are a 501c3 organization. That's what that means, Section 170, meaning we're qualified to receive charitable contributions. And I affirm that I received the property, and you're signing it. And then there's this other thing called I have not agreed that you agree that if you sell the property within 3 years, you will in fact report to the IRS the sale on Form 8282. And I'll explain that in a second. So if you get a really large donation, that's great, congratulations. The donor has to fill out the 8283 estimating the value of the property. They may even have to get an appraisal, unless it's if it's real estate or like I said, furniture or something like that, or it's a work of art, something like that. They'll have to get it professionally appraised. If it's stock, they just have to report the value of the stock. And they will ask you to sign the 8283 just to acknowledge you received the property. There is a donor can deduct the fair market value of household items. These include furniture, furnishings, electronics, appliances, linens, and other items. These are not household items, so there are special, there's a little bit looser rules for household items. These aren't, and these are the ones that are much more likely to require an appraisal. So the basic household items, that's what the breakdown is. We talked a little bit about gifts of stock, exchange traded stocks like shares in mutual funds, stock, bonds. What you do is, in order for the donor to figure out the deduction, is they go at the time the donation is made, not when the stock is sold by the charity, but when it's made, they look at what the value is as quoted in the newspaper at the average price between the highest and lowest quoted selling prices. And closely held stock is probably going to require an appraisal based on the company's net worth, prospective earnings, and dividend paying capacity. Okay. So you do have to acknowledge the donation on Form 8283, and then if you sell, and you should get a copy of the 8283 after you sign it, and if they sell the property, you're going to have to file what's known as an 8282. Basically, that's the 8283, we just looked at that. The 8282 basically says, we sold the property and this is what we got for it. And what the IRS is looking to do is they'll look at what they claimed as a deduction and what you sold it for within the 3 years. And if there's too much of a discrepancy, they may go back to the donor and say, you said it's worth $1 billion and they only sold it for $50,000. Something's wrong here. And so it just notifies the IRS that they want to match up those two forms and see if the discrepancy is too much. And if it is, then they may challenge the original deduction. The IRS also wants to know, sometimes, so get around this, donors would sometimes say, I will give you this property, but you have to promise me you won't sell it until after 3 years. So that you would never report the sale in 8282, so the potential for them to get audited would not be there. But the IRS now requires you on the 8283 to report whether you agreed not to sell it for 3 years. So, so that if you get a donation and they say, well, give it to you, but you can't sell it for 3 years, you have to tell them that. And so the IRS knows right up front, okay, we're going to have to look at this one with special scrutiny. Okay. Someone asked, can board members deduct mileage for transportation to and from board meetings? Generally speaking, commuter expenses are not deductible. So if they're just driving a couple of miles to a board meeting from home or something like that, generally that may not be deductible. But if they're traveling for some sort of special event or a conference or things like that, that's clearly going to be, mileage would clearly be deductible in those cases. But the back and forth to board meetings, I can't say right off the bat. My instinct is probably going to say maybe not. Okay. There are certain times you don't have to file the 8282 if it's publicly traded securities, if it's a small item valued at $500 or less, or if it's consumed as part of the organization's charitable mission. Someone gives you laptop computers and you give them to beneficiaries of your program as part of your computer access or digital access program, you won't have to do that. Or someone donates a car to you and you fix it up and you give it to your clients so that they can get back and forth to work. Again, food supplies, medical supplies, all those things would not have to be reported if you in fact use them as part of your mission. Now, there are special rules for cars, boats, and airplanes. This sort of first started in the 90s or the late 90s, where people started donating cars in particular. People were, there was a lot of, well, the IRS would use the word abuse. I'm not sure the charities and the donors would, but the IRS felt that people were inflating the value of these cars. A lot of them were barely functioning, and the Blue Book value of the cars would be substantially more than what they could sell them for. And so in order to curb that abuse, the IRS enacted, or the Congress enacted special rules that deal with vehicle donations. And basically, if it's less than $250, you just claim a deduction just like you were with anything else. You would want some sort of receipt acknowledging that you gave the car to the charity, but that's all you need. And then if it's between $250 and $500, and again, you need the same acknowledgement for any gift above $250. in terms of no goods or services. This is, et cetera, et cetera. Now, if the car is claimed to be worth more than $500, there is a special form that the donor must file with their tax returns. It's Form 1098-C. Oh, it didn't open up, sorry. So we will close that. Close out. There is a special form that you file that contains information about the car. And again, you need an acknowledgement from the nonprofit because it's more than $250, but you also have to, the 1098-C includes value of the car, Blue Book value, condition issues, and stuff like that to substantiate that it's really worth what you're saying it's worth. And here's a chart. I won't go through all the details, but here's a chart that lists the basic rules. If the organization sells the vehicles, you'll get the smaller of the proceeds or the fair market value. If the vehicle is used by the organization, it's the fair market value. If they improve the vehicle and use it as part of their organization, like they either sell it or they may give it to someone as part of their program, you'll get the fair market value. And if they give it to a needy person or sell it, again, you'll get the fair market value. The only limitation is if you give the vehicle and the organization immediately turns around to sell, is that there is a potential limitation of your deduction. So those are basically the rules for deductions receipting. The important thing to keep in mind is that you want the person to donate again, and so you want to get the rules right. Even though you may not have a penalty, you want to get the rules right so that your donors will donate again. And that's the critical thing. And then there are a lot of great organizations, great publications by the IRS. Let me see if this one shows up. Okay. There's a great one on substantiation of charitable contributions that the IRS puts out. And what's great is they actually have sample wording in here about your receipts. And they'll summarize some of these rules, but they actually have sample wording for your receipts, which is great. And then there's a special guide to vehicle donations, also very useful if you get vehicle donations or for a donor. Some people, some organizations regularly solicit them, others don't. And then there's determining the value of donated property, which is another publication the IRS puts out. It's a little tomier, as you can see. It's 14 pages, pretty dense. But basically, it helps you establish the value. And for you, it's also maybe valuable as well if you, for the silent auctions and things like that. It may be helpful for the nonprofit to determine the value for their quid pro quo contributions. So with that, let me see if there's any more questions. It's an important time of the year. We get a lot of contributions this time of year. Most of them are cash and they're pretty straightforward. But there are others, when you do get the occasional property, it's important that you do it. And as I said, to be careful about any larger contributions so that you're properly receiving them at least by January 31st so that the donor can, in fact, take advantage of the charitable deduction. If for some reason the receipting hasn't been done or you're concerned that your receipt doesn't have the appropriate language, so you sent a receipt to someone who gave you $300 in August, and you look back and you realize, oops, I didn't include the appropriate language, there's still time, like I said, generally by January 31st, to send them a receipt that includes all the appropriate language. And you can then fix it before they run into problems when they go to their accountant. So you may want to pull out your receipts and see what you're saying to make sure it has all the required language, and if it doesn't, in particular for the people who give you $250 or more than $250, you want to go back and double check to make sure that you don't have to send them a new receipt. And if you do, no harm, no foul, as long as you do it in a timely manner. So someone asked me if we are recording this webinar, and the answer is yes. We will send you out an evaluation later today. We will also send you a link to the recording so that you are able to go back and listen to it, or if you came in the middle, then you can do that. There are, as I said, on the interface, there is the handout, so if you haven't downloaded them yet, please feel free to do so. And the great thing is that when you do that, we have a new technology, so you can listen through your computers, but more to the point, if you go back, the slides will change in the same way they did to do that. Now, I do have one more question. Someone says, do you think it's important to send a letter that their donations aren't deductible because your organization isn't 501c3 yet? If they're smaller donations and you did not send them a deduction or a letter saying they were deductible, then you're not required to do it. And the important thing is, once you get your 501c3 status, it will be retroactive to the beginning of your existence. So it will essentially make them deductible after the fact. So I would say, I mean, I don't know how many donations you're getting, but you may want to do it, but they're probably going to be okay anyway, as long as you file for your charitable status within 27 months of your deduction and your creation, and it's in fact granted to you, then it will be as if you were always exempt. So thank you so much. Okay. Anyway, with that, I think that's the last question. So I'd like to say thank you for everybody for being on board. And as I said, you will be getting a evaluation later on today. So have a great afternoon.